Good morning, everyone. It's Thursday. Markets are still crazy. And today, I just wanted to quickly tell you guys about a ratio that people don't seem to ever consider, probably because it doesn't show up in the Robinhood app, to be honest with you. And that's your Sharpe ratio. Now, we have what's called a risk-free rate of return. Right now, it's about 4.35. It's predicated on if you have just $100 million sitting in cash and you could park that in something like a treasury bill, what is your rate of return that is theoretically risk-free by just buying treasury bills? It's about 4.35, okay? It's called the Sharpe ratio. If you have a negative Sharpe ratio, that means that for the amount of, I'm gonna say, volatility or risk you're taking, it's underperforming, okay, your risk-free rate of return. Meaning if you don't beat the risk-free rate, if you're not at least, if your company is not generating on an annualized basis above and beyond 4.35%, you have a negative Sharpe ratio, okay? Something important to notate. So what are the highest Sharpe ratios? Great question. So the highest MAG 10, I'm gonna use MAG 10, Sharpe ratio, would be Google. I think it sits around like 2.2. That's really good. That's a very good metric. What about staple companies? Staple companies, the highest I could find was Walmart. Right. So I like options. I like volatility, but I also like hedging. So I'm looking for highest risk-free rate of return, a nice cash balance sheet. I want a little bit of dividends, and I want two things that are, I want to get rid of any not all risk, because I like risk. I like having a high beta, but I want to offset it with something that's either, zero beta or negative beta, but with a higher Sharpe ratio. Very, very difficult to do, but I'm trying to remove the giant swings in the portfolio and kind of smooth out the ride. And then where I get alpha, right, is selling options and a higher Sharpe ratio. You get a little bit of dividends. You might have some treasury yields, and I can sell options on that while smoothing out the ride. My alpha won't come from, these giant swings up and down. My portfolio will stay consistent, and my real rate of return will come, from hedging. So something I wanted to, discuss with you guys. A lot of people talk about PE ratios, which is a good metric, but I don't know, it's like bringing a battle axe in to do brain surgery. And you're just like, oh, like I think this will work. I think it'll cut. I'm sure it will cut what off. I don't know. Like we're operating on your, on your head. So something to consider. Look at your Sharpe ratio. Is your company performing well? Is it above one? I think you should aim for at least above one. Because if your company is underperforming, your risk-free rate of return, you should just go buy treasuries. Something to think about.